Ladies and gentlemen, good day and welcome to Balaji Industries Limited Q4 and FY25 earnings conference call, hosted by Systematic Shares and Stocks. As a reminder, all participant lines will be in the listen-only mode. If you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone, and you will get an opportunity to ask questions after the presentation concludes. Please note that this conference is being recorded. I now hand the conference over to Ms. Shweta Dikshit from Systematic Shares and Stocks. Thank you, and over to you, ma'am.
Good afternoon, everyone. On behalf of Systematics, we welcome you to the fourth quarter FY25 earnings conference call of Balaji Industries Limited. We are joined today by Mr. Aditya Jajodia, Chairman and Managing Director, Mr. Rajkumar Sharma, Joint CFO, Mr. Vijay Kumar Bhatti, President Finance, and Mr. Ajay Kumar Dantia, Company Secretary, to discuss the company's financial and operational performance for fourth quarter and FY25 work. I would like to thank the management for giving us an opportunity to host this call. Now I request Mr. Aditya Jajodia for his opening remarks. Over to you, sir.
Thank you, Shweta. A very good afternoon to everybody. We are pleased to welcome you all to our Q4 and FY25 earnings con call. Our investor presentation and financial results have already been uploaded on the exchanges, and we hope that you have the opportunity to review it. Despite the industry-wide challenges, and particularly in an environment where there was a slowdown in the government orders in FY25, I am pleased to share that Balaji delivered a resilient performance and continues to strengthen its core competencies. Our strategic emphasis on the value-added segments of DI pipes and specialized ferroalloys remains firm, and the steady progress being made to expand the capacities and capacity utilizations in these high-margin areas. Additionally, the board has approved a proposal to diversify our product offerings also into other pipe and tube segments also, an initiative which will leverage our existing portfolio and tap into new growth avenues. We are also making consistent headway in reducing our net term debt, further strengthening and enhancing the flexibility of our balance sheet. Before discussing the financial and operational performance, I would like to highlight the following. Strategic updates for Q4 and FY25. Firstly, the updates on the capacity expansion plans. We are actively delivering on our capacity expansion commitments. In Q4 FY25, our company successfully commissioned an additional 2.04 lakh tons of ductile iron pipe capacity, increasing the total capacity from 3 lakhs to 5.04 lakhs. A further 96,000 tons is slated to be commissioned by FY26. Also, in ferroalloys, the capacity is set to rise from the current 1.66 lakh tons to 1.9 lakh tons within the expansion schedule for completion in Q1 27. Capacity of TMT bars also has been increased from 2.6 lakh tons to 3 lakh tons due to debottlenecking capex. Additionally, one of the blast furnaces had already been revamped and commissioned, with the second expected to be completed by Q4 of 26, boosting the total hot metal capacity from 6.3 lakh tons to 7.5 lakh metric tons per annum. Also, the central capacity of approximately 9 lakh tons is expected to increase to 12 lakh tons by Q4 26. And for more information, you can please refer to slide number 13 of the investor presentation. Secondly, coming to the updates on the capex plan. We are nearing the completion of our 1,000 crore capital expenditure plan for the capacity expansion. Of this, approximately rupees 822 crores has already been deployed, and with the remaining investment expected to be made over the next 12 months. The entire capex is being funded through internal accruals, reflecting our strong financial discipline. For FY26, we have provided a capex guidance of around 175 crores. The company continues to make significant progress in executing its net term debt reduction strategy. We have successfully brought down our net term debt from rupees 871 crores in FY23 to rupees 221 crores in FY25, we are very pleased to share that our net debt to EBITDA ratio for FY25 stands at 0.25, substantially outperforming our earlier guidance of maintaining it around 0.6 as of March 31, 2025. Coming to the operational performance, for FY25, production of all the products showed an increasing trend, except for TFT bars. The production for ferroalloys and DI pipes increased by 8% and 17% respectively, and sales for ferroalloys and DI pipes increased by 1% and 8%. On the realization front, realization for almost all the products showed a slight decreasing trend. On a quarterly basis, the production of DI pipes stood stable, and ferroalloys dropped on year-on-year basis, where sales for both showed an increasing trend as Q-on-Q and Y-o-Y basis. Realizations showed a decreasing trend. Coming to the financial performance, on an annual basis, the revenue and EBITDA showed a drop owing to sluggishness in the market. Despite these challenges, I am happy to share that our gross profit annually stood at around 14%. The margins stood at it was 26%. No, sorry, I just goofed up my numbers. The gross profit was 36%. The EBITDA was 14%. Margins were 33%, and the return on equity was around 26%. On a quarterly basis, the revenues increased on QOQ basis. However, EBITDA and PAT decreased. In conclusion, as we look ahead into FY26, we are optimistic about a potential rebound in the government ordering activity. With this encouraging outlook, we are targeting revenue growth of around 25 to 30%, EBITDA margins in the range of 16 to 70%, and DI pipe production surpassing 4 lakh tons. We remain fully committed to leveraging our core strengths to drive sustainable growth and respond effectively to the evolving needs of both domestic and international markets. Backed by our enhanced capacities and strong financial foundation and an experienced leadership team, Balaji is very well positioned to create long-term value for all its stakeholders. We can now open the floor for question and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shlok Bhartiya from Swan Investments. Please go ahead.
Hello. Good evening, sir. Thank you for the opportunity. Sir, I just had 2 questions. First, can you give the guidance for FY24 regarding revenue? Hello. Am I audible?
Now you are.
What's the guidance for FY26 revenue and EBITDA?
We have given a guidance of 25% increase in next year and EBITDA margin of 16 to 17%. What we have achieved in last year, the current previous financial year, was 14%.
And sir, the DI pipes production volume was in the FY25. Can you please explain the major reason for this? And are you confident about achieving the target in FY26?
I don't understand what is the question because the voice is not coming clear.
Hello?
Can you repeat your question? Maybe louder.
Sir, in FY25, you missed the DI pipe production volume, right? So what's your target for FY26, and will you be able to achieve it?
We achieved 282,000 in FY25, and as per the internal assessment, we should be able to produce 4 lakh tons of pipe in the next financial year, the current financial year.
Okay. Thank you so much, sir.
Thank you. Participants may press star and 1 at this time to ask a question. The next question is from the line of Manav Gogia from Yes Securities Limited. Please go ahead.
Yes, very good afternoon, and thank you for the opportunity, sir. So the first question is, on the ferroalloys division, we are currently taking a capacity expansion. If I recall, we were scheduled for this capacity expansion to get completed in early FY26, and now the presentation mentions it as Q1 FY27. Could you just, highlight the reasons behind the same?
Yeah. Actually, this project was a little bit delayed because of some very critical equipment which was to be coming from China. So there were some issues at the Chinese supplier end. So some issues happened over here because it was what we were trying to develop here was slightly innovative, and it was one of a path-breaking technology. So some changes were required from our end also and at their end also. So this has been delayed a little bit.
Okay. Sure, sir. So just following up on the ferroalloy segment, one thing I wanted to know is, that our utilization rates are lower than what the current capacity is. And, we still continue to take some expansion plans for the segment. So can you just give me what sort of sustainable capacity utilizations are we targeting for the ferroalloy segment?
Since we are making specialized ferroalloys, the capacity utilization we expect to be within the same range. It might also go down by a few percentage points as we increase the specialty grades of ferroalloys.
Okay.
The value goes up, but the absolute production figures might go down a bit also, depending on the valuation.
Okay. Sure, sir. And so, just another follow-up question. It was much more on your opening remarks where you mentioned that FY25 saw that there was a temporary slowdown in the government orders. Could you give some details on the same, and what do you expect how, it's shaping up for FY26?
See what had happened. In the last year, prior to the elections, the government was in a very, I will say, easy spending mode. Post-elections, though the same government was in place, but a lot of spending actually on the ground got a little bit constrained. And also because of the many social schemes which were floated by many of the state governments, a lot of money, as you all know, was diverted to these funds. So because of this, in some sectors, the spending actually slowed down. So now what we are expecting is that with the financial year over and with the new budget being announced, so now accordingly the government will be able to take a course of path correction to rectify these things. And the order book should be robust from here onwards.
Got it, sir. Thank you so much. I'll join back the queue for more. Thank you.
Thank you. Before we take the next question, we would like to remind the participants to press star and 1 to ask a question. The next question is from the line of Poojan Shah from Molecule Ventures. Please go ahead.
Hello, am I audible? Hello.
Please little louder, please.
Yeah, sure. Wait, okay, no? Yeah. Actually, my first question would be on the industry side. So considering the JJM, we have seen that there was a slowdown, as you mentioned, in the early remarks.
We are unable to hear
But recently, the government has also increased the allocation for JJM, roughly around 270,000 crores. So, do you feel the green shoots being happening on the grounds right now in Q1 FY26 onwards, and that could help us to get a good order book on the sides?
You are not audible. Sorry
to interrupt, sir, but your voice is breaking. Could you please move to a better reception area, Mr. Shah?
Yeah. Is it audible now?
Yes, sir. Please go ahead.
Yeah. So my first question would be on the JJM side. So we know there was a slowdown in the JJM so for the last few months, and recently the government also increased the budget and the capex for the JJM side. So is that the green shoots been visible, or the more on the idea is to understand that the current budget which the government has allocated is sufficient to get the revamp in the JJM?
Yeah, absolutely. Because with this budget, and if the money is actually spent on the ground, then this is enough money to cover the necessary demand and supply. Actually, what has happened last year also, towards the second half of last year, over the last 6 months, the spending slowed down a little bit. But now the signals which we have from the market is that from here on, the things will be better.
Okay, got it, sir. And sir, recently we have seen that we are foraying into OPVC pipes. Now, just wanted to understand, as we understand that this is the replacement for the DI pipes. So, just wanted to understand on a broader aspect. So, few quarters back when we had a con call, the OPVC pipes segment was not been encouraged so much. So what the dynamic have been changed right now, and is that the adoption being very strong, or how's the situation right now?
I'll explain. See, the stand which we have taken is that OPVC pipes, like in India, we have a lot of pipe materials. We have HDP, we have PVC, we have OPVC, we have LSAW, we have SSAW, we have steel pipes, we have cement pipes, fume pipes, we have DI pipes also. So every pipe has a different application and a different life cycle. So in DI pipes, we will continue to expand and we will continue to be our main business. This OPVC pipe, this is a new alternate material which has been developed. In all probability, this demand for this is now being tested, and this is not going to eat into the requirement of ductile pipes. If at all it is going to have the market share, it will take something from the steel pipes, mostly from the plastic pipes or the HDP pipes, because the pressure resistance of the OPVC pipes, it is very low. For very high pressure applications and for high life cycle applications, it will still not be suitable. But the urge to go into this was that most of the buyers of the ductile iron pipes are the government bodies, and also the buyers for the other pipe materials also, like OPVC or plastic or steel, etc., etc. It is also the government. So the company saw that it may be an opportune time to enter another segment of pipe also, so as to ultimately enter more available products to the customers. Same set of pipes.
Right. So I just wanted to understand more on this part. So as you know that there is a constraint in the supply of equipment right now, because one of our key supplier, which is a Spain player, is they have a supply crunch. So when are you planning to expand this space, and what capex we will spend in this area, and in terms of lines, in terms of MTPA?
To be very honest, our current capacity for OPVC is very small. We are starting with initial capex of less than $2 million. And our total capex will not be over 100 crores across a few years. So it's a very, very small module, and the expansion in OPVC is not very, very large. The basic idea was that we have some marketing synergies, and we have some loyal customers who want DI as well as some OPVC pipe for the projects. So we're having a basket of products to cater to the customer needs.
Right, sir. So the technology what we have been procured is a domestic, right?
Technology we will not be comfortable discussing now. So once our production is online and once we enter the market, we'll be able to inform you better about that.
Okay, got it, sir. And I will join back in the queue. Thank you so much.
Thank you. Participants who wish to ask a question may press star and one now. The The next question is from the line of Rudraksh Raheja from iThought PMS. Please go ahead.
Thanks for the opportunity, sir. I wanted to ask about which sizes is this OPVC competing with DI pipes, and what percentage of DI pipes market share can be taken by OPVC?
Hello? Yeah, so the OPVC pipe facility we are putting, it's just one line, that too for small dia. As mentioned earlier, we do not expect OPVC to largely eat into the market share of DI. We expect this to first enter the market as a replacement for the HDPE pipes. Obviously saying that there might be a very small portion of DI replacement, but that is not something which is, our target goal. Our goal is to again cater to us who want both DI and OPVC.
Got it, sir. Got it. And sir, compared to DI pipes, does installation of OPVC cost more or less? And if you could highlight a number for us.
The exact numbers we are not really aware of, but the entire life cycle assessment cost which the government had declared was that the still DI pipes is the cheapest pipe material in India for that pressure application.
Okay.
Answered your question?
Yes, sir. Compared to this, if you could highlight how much would be the cost difference?
There is no such comparison because OPVC has a pressure rating of less than 15 kgs, whereas a DI pipe pressure rating is more than 50 kgs. So I can't have a cost comparison directly. Generally, a plastic pipe always will be cheaper to the steel pipe, but you can have a cost comparison.
Understood. And sir, regarding demand of DI pipes in the current market, has government funds started to release?
The budget, after the budget, now the funds will be released in a couple of months, and the demand has already started coming up, and now the discussions also start happening.
Good to hear that, sir. Good to hear that. And sir, what is the profitability EBITDA per ton in DI pipes today, and where do you see this settling once demand revives?
Okay, just a minute. Well, for the last year, FY25, the ductile iron pipe, we had a EBITDA per ton of 19,000 rupees. It has come down slightly, but what we assume over here, and we budget also, that this is probably the lowest level and things should improve from here.
And sir, where would you go this number? Any upside that you see potential that we could attain here?
Upside, if the market is good and say the demand comes back and whatever committed expenditure that the government has announced, if that is spent, it should be somewhere in the region back up to 23,000-24,000, which we had already achieved in first 2 quarters of this previous financial year.
Understood, sir. Understood. And sir, what is our capacity utilization in DI pipes at this point of time?
Capacity utilization, just give me a second, I will come back.
Hello?
Yes.
So last year, last utilization on a weighted average basis was about 90% because the plant was commissioned in the second half. And in current year, we are predicting approximately 80%.
80%. Got it, sir. Got it. And sir, are we planning to export DI pipes as well like we do with ferroalloy?
Yes, of course, we are also exporting DI pipes, and we will be expanding further on the export market as we are doing for ferroalloys.
Understood. Sir, could you throw some light on your raw material prices? And you could let us know average iron ore and coal cost for even FY25, and how is it trending in this Q1 FY26?
So our major raw material, as we know, are coking coal and iron ore.
Yes, sir.
So prices are more or less flat. They might be different, so maybe 200 rupees per ton plus or minus on a Q1Q basis, but on average more or less flat. And coking coal prices, we are projecting to fall by $10 compared to the previous year.
Got it, sir. Got it. Thank you.
Thank you. Before we take the next question, participants who wish to ask a question may press star and 1. The next question is from the line of Radha from B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. So my question was, you mentioned to the previous participant that government is the key customer, and the customers now want both DI and OPVC. So just wanted to understand which states are demanding OPVC currently, and in OPVC, how much capacities are you targeting in the next 3 years, and how long will it take for you to set up the capacities?
On these marketing questions, we can answer later, but currently only a couple of states have already introduced OPVC, and it is also replacement plastic. And in the near future, on the capacity once we start, we'll be ramping up slowly, as we told earlier. So once we can come, maybe the next con call, we will take to the capacities what you're planning ahead.
Okay. Secondly, apart from OPVC, are there any other pipes that we are looking into? And if yes, how much are we planning to invest there?
Our major focus will be ductile iron pipes only. As we have told earlier that from current production levels, we are further expanding in this FY26 by 1 lakh ton. So our installed capacity from 5 lakh tons will be 6 lakh tons in FY26. So our main focus will be ductile iron pipes only.
Okay, sir. Thank you and all the best.
Thank you.
Thank you. Participants may press star and 1 to ask a question. The next question is from the line of Kaustubh Shah from Wallfort PMS. Please go ahead.
Hi, sir. Thanks for the opportunity. I had one question on the margin front. So basically, if you so our Q4 margins have come down. Obviously, the realizations are down and the raw material cost is up. So and we are guiding for a 16% still EBITDA, whereas 8% EBITDA is what we have clocked in Q4. So what will change in the ensuing year, which gives us confidence that this will turn around, both from the realization front and the cost front? That is my first question.
If you look at 4 quarters of the last financial year, you will see the answer will be in front of you only. The prices have come down by 5,000-6,000 rupees, and that is only because of the demand being low. Once the demand is back, the prices are going to go back to the same level. And if we are talking about only quarter 4, the margin has come down to 8-9%. It also includes the inventory losses. When the prices come down, there are inventory losses which also have to be booked in the quarter itself. So it is a cumulative impact of the prices coming down and some of the inventory losses that we had to book.
Okay, got it, sir. This was helpful. Secondly, on the working capital front, we have seen the working capital increasing in the Q4. So my question is whether it will be at this level only, or we see working capital again coming off. Was this more of a Q4 phenomenon? I just wanted to understand.
once the demand is slightly low and we have continued the production probably at 90% of the same level, the inventory pile-up is there. We have orders. Orders have been placed. They have to pick up the quantity, and they have to arrange the LC and BGs. We are waiting for that. Once that is completed, the orders will pick up. The inventory build-up is there. It is inspected, and it is waiting for delivery.
Okay, great. Yeah. And the last question from my side, you mentioned to some previous participant regarding the ferroalloy capex being delayed because of the machinery or not critical machinery not coming from China. But now whether that problem has been sorted and everything is on track for the capex now?
The problem has been sorted, but the supply chain will take some time to deliver, and expecting to start the plant by Q1 of next year.
Okay. Thanks. Thanks for answering my question. That's it from my side. All the best.
Thank you.
Thank you. Before we take the next question, ladies and gentlemen, you may press star and 1 to ask a question. The next question is on the line of Devesh from Finrest Capital. Please go ahead.
Hello. Hello, sir. Am I audible?
Yes.
Congratulations on a good set of numbers, sir. Sir, my first question is related to the EBITDA margin that you have said about 16 to 17%. So what's the strategy for this? How will you clock this kind of margin, sir?
This 16 to 17% margin, and currently for the last year it is 15%, and on the higher side it was 19-20% also for some of the quarters. So 16% is not a number which is not achieved.
Okay.
This is the estimation that the management has taken. It will be achieved in the current financial year as we think, one quarter here and there.
Okay, sir. Sir, my second question is regarding the receivables and payables. It has been increased and it is affecting our working capital. The working capital has been increased almost by 2x, sir.
To be very frank, what has happened is players who are some of our buyers, their payment from the government is also delayed.
Okay.
So that has some of the government payments are also delayed, and it always happens before the budget, and it's resolved once the new budget is in place and the disbursement starts to happen. So this should come down by the end of this quarter.
Okay, sir. Sir, so if you can provide segmental EBITDA per ton for your segment, sir.
I have the yearly numbers in front of me. Sponge
Okay.
iron per ton. Pig iron was 4,000 rupees. Ferroalloy, on a blended basis, was 20,000 rupees. Pellets, MS ingot was 2,000 rupees. TMT bar was 4,000. And ductile iron pipe was 19,000.
Okay, sir. And sir, my last question is regarding depreciation. As our plants are getting commissioned, so what could be the depreciation going forward, sir?
Our current depreciation, if I have it, for the last financial, it was 63 crores. 94 crores as compared to in FY2023-24. Once all the plants are commissioned, it can go up to 105, 110 crores. An increase of 10 to 15 crores.
Okay, sir. Thank you. That's it from my side. Thank you, sir.
Thank you. Participants may press star and 1 at this time to ask a question. The next question is from the line of Shweta from Systematic Shares and Stocks. Please go ahead.
Hi, good afternoon. Thank you. So a couple of questions. First, relating to the DI pipe expansion, could you just verify we're expanding DI pipe to 660,000 tons or 6 lakh tons by the end of FY26?
It is 6 lakh.
6 lakh. So it was earlier planned to be 660,000 tons.
We have reduced two of the spinning machines, which the higher dia side, and we have finalized it lakhs only.
Okay. Understood. So second question is on your capital allocation policy going forward, because we are yet concluding our existing capex, and our target, we've been on track in terms of debt reduction, but there is still residual capex to be done for this DI pipe expansion, as well as ferroalloys also stand extended to first quarter FY27. So could you just highlight why are we, as of this point, expanding into OPVC while the existing capex is already going on? And when are we expecting to break ground in terms of the OPVC expansion? Also, what can be our annual capex for the next 2 years, and where are we looking how are we looking to fund it, and what are our debt targets for the next 2 years?
Madam, this was like too many missiles and too many drones at the same time. It was like swarm drone attack. Okay, too many. Okay. So, if I hear you correctly, number one, I will just answer them not one by one, but I think the most important thing is that, madam, is that OPVC, it has been giving a lot of meters today, I think in today's conference. OPVC, the investment which we are making, it is very, very negligible. As we just mentioned, it is around 25 crores, 20 crores only. It's a very small investment just to see that what is the potential of this material to replace the plastic. And if at all we can open up a new segment in the near future or not. If we succeed, then probably we will be looking at something next year. If not, and if we see the viability, otherwise we may drop it entirely. As of now, we can consider it to be a very, very trial product for Balaji. So let's not let us not attach a lot of importance to OPVC at this moment of time, number one. Number two, regarding the capex plans, out of the balance capex plans, it is only 170-80 crores it is now pending. And as we have already declared earlier also, this entire capex, it is being funded by internal accruals only. So you must have seen in our cash flow statement that whatever cash flow we generated last year, so out of that, after repayment of the term loans, whatever remained, 50% of it went into enhancement of working capital, 50% of it went to new expansion, means that the capex. This year, the capex figure, it is so low, is that the majority of the money will be going towards, firstly towards the waterfall will be the repayments of the debts, the second will be complete the capex, and also wherever it is required, we will be enhancing the working capital also to improve our improve the profitability. I think I've answered your question, or is there anything else to be answered on this?
So, out of the 170-180 crores capex, the majority of it is likely to come this year itself, that is FY26?
Yeah, the majority will come this year only.
Okay, and debt will, what's your target net debt number now?
The remaining repayable debt is only 221 crores. The capex is 175 crores. That adds up to 350 crores, 375 crores. So that we will phase it as per the cash flow availability. Second, what has also happened, the working capital has, the inventory and the debtors has absorbed a lot of surplus requirement was there, and they have absorbed some of the cash. Once that is released, it will be available.
Understood, sir. Thank you so much for the detailed answers.
You must see the historical numbers. Last year we did a cash flow EBITDA income of 800 odd crores. Out of that, 350 has been spent in debt repayment, plus minus 5 crores, 350 has been spent in capex, and balance 100 crores is for working capital increase. The same thing is going to happen. What we have a budget of 221 crores. Out of that, approximately 175 will be paid in the current financial year and the balance in next financial year. As far as capex is concerned, it will be 175, even if we have to do the entire capex. So that both adds up to 150 crores. Last year and previous to that year, we have done a cash flow EBITDA of approximately 850 crores of average. I think that answers your question.
Yes, sir. Thank you so much.
Thank you. Participants may press star and 1 to ask a question. The next question is from the line of Saket Kapoor from Kapoor & Co. Please go ahead.
Hello. Namaskar, Aditya ji, and thank you, sir. Thank you to the team Sharma ji for providing the opportunity. Sir, firstly, as you alluded to the fact that lot of mind time has been spent on OPV. So, sir, if you could just give firstly on the DIP landscape currently, sir. अभी current India में क्या capacity है currently taking the entire geography north, south, east, west, and utilization levels for the industry, and the new capacity that we are anticipating for the current 2 financial years. If you could give us a thought process firstly on that.
Currently, the India's capacities in the last 2 years have been the same. Output has been the same. Some additions were there, but due to the fund scarcity, they couldn't materialize in terms of output. And seeing the current numbers and the current requirement of funds and everything, I doubt any further expansion is going to happen in the near future. So only the existing players which are there will be doing the work. No new players are expected soon.
One more point to add. As we mentioned in the last phone call to you only, Mr. Saket, आपने पूछा था, as I remember, क्या है कि to put up a new capacity of DI plant would mean a very huge capex. पूरा steel plant पीछे से लगाना पड़ता है, उसमें time भी बहुत लगता है. It is a very time-consuming process of 3 to 2 years, at least for 3 to 5 years, and also it requires a huge capex. So it is not that somebody would imagine कि addition आज करनी है और वो 6 महीने साल भर में हो जाएगा. तो existing players जो brownfield कर पा रहे हैं, जिनका plants है वही कर पा रहे हैं. उसके अलावा किसी का plan वो विशेष ऐसा है भी नहीं और वो immediately आने वाले भी नहीं है. Okay. So translation. Okay. I just changed the language. So what is happening is that in the immediate future, we are not foreseeing any new players entering into the market, and the existing players also, whatever they are announced, whatever is in the way of being added, that will be added. As far as we look at it, what you asked in the next 2 years, probably another capacity addition of say around 12 to 15 lakh tons will be added at most over the next 2 to 3 years.
Okay. And sir, as you also mentioned that there was some slackening of response from the government side in terms of order tendering and release of funds. So post the budget and the new financial year, have you received any further new orders in any of the schemes, and how are the realizations currently shaping up in terms of the raw material prices being softened? How have the price trends been for the DI pipe sales realization?
See, in terms of new orders, most of the orders they are in the pipeline, and all the parties they are ready to place the orders. They are also realizing that it is a very good time to place the order. But what has happened is that for the last 3-4 months, the fund flow to these particular projects and to the infrastructure contractors, it has been actually very slow. You might have seen that even in Maharashtra, you must have read in the papers only, is that just for an example, is that the Maharashtra government it is withholding contractors' payments, whether be it in pipe projects or whether be it in water projects or whether it be road, whatever. So there is this slowdown of maybe the spending a little bit, But now after the budget, we are expecting that in the month of May and June, things will be normalized from here onwards. So with that, the order flow should be more than normal because the last 3-4 months order booking has been slack. So from here, it should be picking up. In terms of realization, because of the slow inflow of orders, naturally the realizations at this moment of time, prices have come down to a slightly lower level, which we feel is that we are very close to the bottom. And as soon as the funds are released and the demand gets released, prices should come up. But the advantage which we have, that we are a very low cost producer, so the drop in prices by 3-4%, 5% does not bother us much. This is something which we always factor when we are considering the average margin. We have not taken a very aggressive margin projection.
Okay. So you are, sir, for the new orders, or whether जहाँ पर अभी हम tendering कर रहे हैं, we are seeing 4 to 5% lower bid than what the average had been earlier. This is what the understanding should be?
By and large. Somewhere 4-5%, somewhere 6%, that's it.
Okay. And correct, sir. Now, sir, coming to some of the questions for the financial part. Firstly, sir, on the tax front, we are only paying closer to 4 crore rupees in terms of the direct taxes as the cash flow speaks. So, if you could just explain to us the current advantage we have and when we will be paying the MAT taxes and some clarity on the same.
As far as cash flow of the tax is concerned, we started the last financial year with 1,000 crores carry forward tax losses. Out of that, 750-800 crores has been consumed, and still we have started this current financial year with a carry forward tax loss of 250 crores. After the profitability of 250, we will be in normal taxation.
Right, sir. And lastly, on the capacity addition, so for this financial year, sir, we are expecting tonnage closer to 4 lakh tons for the DI pipes, sir, on a capacity of 5 lakh. This is what you have guided.
There also, what we are trying to say is we have announced a conservative number, and we'll see how the market moves in next 2 quarters, 3 quarters. We'll be meeting every quarter. If there is any adjustment to be made to that number, we'll definitely make it.
Okay, sir. And last point, one of the players in the industry in the earlier call was also alluding to the fact of coming up with HAM type of projects where equity would be there for the companies who will be participating in the DI pipes procurement part. So have we heard anything in the new tendering process wherein the center share is going down and the HAM type of story which is there in the road and all are also to be replicated in the DI pipe model also, sir? Any color you want to give on the same?
This is something new to us, but the HAM is a very long story and it has been discussing over past many years of many departments and tendering bodies. But till now in India, this HAM is not a successful model yet, and I doubt that any of the competitors and producers will be liking to go ahead with the HAM scheme.
Okay. And lastly, sir, so much has been spoken about the government finances strain and diversion of funds towards other non-productive activities, quote unquote, if I may use so. So do you think that the best of the time for this Jal Shakti, Jal Jeevan scheme or the interlinking, which is not even the countries we have not said, the best time is back for us, or abhi sir is ye scheme ka benefit milne mein or to get to this place that is forward? Is the best of time for the DI pipes in terms of margins, in terms of the availability of orders is behind, or now things may look better from there? And also on the interlinking of river part of the story, if you could just share your thoughts in terms of the Ken-Betwa project and the other which we can see in the website of the Government of India. So where are things in these two aspects, sir, if you could just clarify?
As you have rightly said, that there is a lot of scope coming up within the last 6 months. work has started in the entire country. So on a pan-India basis, the people know that the government knew that the JJM is not going to end soon. This is the reason JJM has been extended till 2028. And if the state funds are released from the center, the equivalent funds will be released from the states as well. There are a few major states where above 40% of tap connections are still pending. And apart from JJM, as you have said, interlinking projects, Kane Becker projects have already started procuring pipes and orders have been placed to the contractors. And further, procurement of pipes will happen soon. Apart from the interlinking of rivers, there is also Amrut 2, where there will be further funds coming up in this budget. 10,000 crores have already been allotted in the Amrut scheme. And irrigation is one major part where you will be seeing demand coming for DI pipes. We are also working ahead to work on the power and the industrial belt, where you will see that DI pipes will be further used in the power industry and in the industrial part as well, where there is a lot of scope left which can be explored.
Yes, sir. Thank you, sir. I joined the queue for two more questions. Thank you.
Thanks.
Thank you. The next question is from the line of Poojan Shah from Molecule Ventures. Please go ahead.
Hello. Thanks for the follow-up, sir. So, if we wanted to break the DI industry into two parts, so let's suppose if the industry is under 400 versus above 400. So, can you give us the actual size and the market, the segmental market is growing between both the things?
This is a detailed question. As per the general mix which has happened in the past year, it is going to happen the same way. There are different areas where you have the rivers coming to the main segment, there's bigger pipes, smaller dia pipes. So the ratio remains the same. It is on the projects and different sites where the demand will be coming up. So we can give you a detailed answer once you mail us your particular query. So you can give a detailed answer later. So there are tonnage, there are meters. It cannot be given across the call. So you can give me a detailed question. We'll answer your query.
Sure, sir. Done. So just wanted to understand a broader aspect is that ratio would remain at a 50-50%, or considering the last year's tendering?
It cannot be commented.
Okay.
It's a marketing. It's a very, very typical marketing question. A business development team should sit with you and give you the actual answer.
Sure. Then we'll connect offline. Thank you.
Thank you. The next question is from the line of Saket Kapoor from Kapoor & Co. Please go ahead.
Yeah. Yes, sir. Sir, if you could give us some color on the order book, currently the pending order book for DIP, and our expected tonnage for the ensuing quarter, sir.
So, the current order book in hand, we have already 145,000 tons order in hand, and as they've given you an annual target of 4 lakh tons, so we are reaching that, and as soon as the funds are released from the government, the capacity and the output will be increased on a month-to-month basis.
Okay. And you also confirm that for the first 45 days of this current financial year, we haven't bagged any fresh orders in DIP, the order booking?
Yes, we have done order booking for the first 35 days also.
Okay, so in that case, the pricing is 5 to 6% lower than the previous quarter. That is what you were specifying in, or if you could give us some color how the pricing has been for this current financial year.
What is the wait? Just wait for the quarter. 35 days orders have come. We cannot disclose the exact price at which you have taken the orders, but on a quarter-to-quarter basis, the 5 to 6%, there is a reduction of prices. And don't worry, whatever projections you have done, this is a conservative figure on a year-on-year basis. So the prices are already at a bottom level. This will improve as the funds come up and further production are increased.
Correct. Sir, on a Q-on-Q basis, when we look at our financials, we find the other expenses have moved up from 298 to 331 crore. Line item other expenses. Can you explain this reason? And when we compare Q on Q, any one-off items we have, sir, that we need to factor?
That we have to go in details. I will not be able to give you the answer right now because I don't have the exact breakup in front of me.
Okay, so then I'll take offline and speak to the team.
Tomorrow morning, I'll be happy to answer.
I'll take forward, sir, and thank you once again, sir, for elaborate discussion, and we hope, sir, that things do start trending towards better for industry going ahead, sir.
Thank you.
Thank you, sir, and all the best. Namaskar, sir.
Thank you.
Thank you very much. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you everyone for joining the call today. We trust that we have addressed all your inquiries to your satisfaction. In case you have any remaining unanswered questions, please don't hesitate to contact our investor relations agencies, Go and the advisors. They will be more than happy to assist you further. Thank you.
On behalf of Balaji Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your